Hello, everyone. Today on the final bar, my guest is JC Parets from StockCharts, helping us break down this bear market rally that is starting to show some signs of fatigue rolling over today, following through from yesterday. And the question now is the beginning of the next leg down as we process things, or is this a pause before some sort of further recovery? I think JC will help us answer some of those questions. Also, we're going to answer your questions from the final bar mailbag, including crude oil going sub-zero. What does that mean? Ladies and gentlemen, this is the final bar. Hey everyone, welcome to today's edition of The Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in Redmond, Washington. Thanks for joining us every weekday after the close to break down the day's action from a technical perspective, try to connect the movements of today with the long-term trends. And I feel like this period, more than ever, it's so important to have a proper long-term perspective. What comes to mind on a day like today is that long-term trend following model that we've talked about a number of times, and it's all built on the long-term trend in the market using long-term weekly data. And the reason why we do that is to try to put these swings into proper context. What is the long-term big picture multi-year trend? What's that medium-term trend? And then how does the short-term movements of this day and this week fit into that long-term trend? So hopefully we'll help answer some of those questions with you as we go through the course of our 30 minutes here together. Also, on the show and elsewhere on StockCharts TV, we have some fantastic guests to help us along the way. Tomorrow, we have Jeff Huge from JWH Investments outside of Minneapolis, Minnesota on the 23rd. On Thursday, we have our friend Tony Dwyer from Canaccord Genuity joining us. Next week on the final bar, we have Craig Johnson from Piper Sandler. I almost said Piper Jaffray there. Piper Sandler joining us next Tuesday, and then Todd Sohn joining us next Wednesday, the 29th. Also on Behind the Charts, Todd Gordon actually sat down with us not too long ago, and we'll share his background, how he approaches things, how charts fit into his process. And Behind the Charts is a great way to just get inside the head of some of the best strategists, experts, traders that we can find, and how they use technical analysis as part of their decision-making. Wanted to get on to our market recap. So as I've told you many times, if you really want to create excitement in your life, try to do a closing bell show in this environment, because things seem to change dramatically going into the close most days. Today was not too much of a surprise because we'd been weaker really out of the open, and the morning sort of tripped lower on the S&P, and really in the last 30 minutes, stocks rolled over to finish toward the lows. So the S&P finished down just over 3%, around 2735. The mid-cap index, the small-cap index down a little less, which is a little unusual. Usually you've seen small and mid-caps sort of struggling relative to large caps, but this is really the S&P leading the way lower. This sell-off has pushed the VIX back above 45, so it was down in the 30s for a day or two, I feel like, at most, and then back up above 40 and continuing to go higher. So again, that measure of uncertainty is not necessarily a contrary indicator for stocks. It really is a fear gauge. It's a measure of volatility, a measure of uncertainty. But uncertain times isn't usually what you associate with market tops. It's more market bottoms and the volatility that precedes them, that includes them. So I think that's where we're seeing the elevated volatility from. Looking at a daily chart of the S&P, you can see how we're starting to, I think, me and many others have talked about this bear market rally approaching, sort of that normal place at which you'd expect some sort of rollover. And we've seen that a number of times. We've seen some key levels come and go, but I think this most recent time as we, broached the 50-day moving average, but went back below it. This was yesterday. We sort of saw that reversal back down. And now with a lot of stocks and also the S&P as a whole, some of the sector charts, if you take the low from the third week in March, connect that to the low, in this case, from the first week in April, Today, we actually broke below it. So we're actually starting to break down through trend line support on that short term, on that tactical time frame. And while that alone does not say that the market's going to go back down to 2200, for example, it certainly speaks to some internal weakness here. And we've seen, questions with momentum. We've seen the RSI not eclipse 60 with a lot of things where in a healthy environment and in a bull market environment, something really building upside momentum, you'd see the RSI get above 60. And for a lot of stocks and also for the market as a whole, we're not actually seeing that. Now we're seeing the RSI right back at 50. So, again, I think we potentially are seeing the beginning of this follow through that I think many have been expecting, which is a bear market rally is unlikely to go back to the previous highs. So somewhere between the bottom and between the peak, you'd expect some sort of pullback, and between 50% and 61.8% is where most people would probably expect that. So we'll have to look at some of the individual charts and see what sort of follow through we may be witnessing. Looking at some non-equity asset classes, bonds actually up on the day. So there have been times that's not a guarantee that stocks and bonds will move together or that they'll move separately. And to be honest with you, I feel like those connections and disconnections are very fluid. I would love to think of John Mark Murphy's original work on intermarket analysis as being static, but talking with him many times, he points out the fact that those relationships are fluid, and understanding the dynamic nature of how these markets relate is actually pretty important. So today we had stocks selling off. We had bonds in the form of the TLT actually up 1.25%. Commodities certainly have been a place of weakness, and I'm starting to mentally block out the percent change in anything related to oil because it's almost to a level of absurdity dealing with some of the movements that we've seen. Later in our mailbag segment, I'll address some questions on oil going to negative and what that actually means, especially for long-term investors. I can give you some thoughts on how that relates. But oil prices by any measure certainly weaker today, and that certainly seems to be a continuation of what we saw yesterday. But also gold down a little bit, silver, other precious metals, copper also breaking down. So across the board, commodities certainly weaker, and the DBC, which is really heavily weighted toward oil, down almost 5% today. In terms of sectors, you had a real defensive play at the top of the list. So real estate, utilities, everything down, but those were down the least, down 1.5% or so. So REITs and utilities, number one and number two, followed by energy. So at a time when oil really cratering, you had energy stocks down, but not down nearly as much as other parts of the market. I think, for bulls, it should be concerning that technology was actually the lowest performing sector, down over 4%. So, when stocks are down, let's see, 3%, technology down even more, leading the way down. That was really the big outlier on the downside. Financials also down more than the market average, followed by communication services, then healthcare. So these groups that had been leading tech, healthcare, consumer staples, two of those really toward the bottom of the list. Consumer staples actually selling off a little less in the market, but again, still fairly negative. In terms of industry groups, not many. There are only a small handful that were above the zero line. Mortgage REITs, maybe the only one that was significantly higher, along with a smaller group within consumer discretionary. But overall, the average group down pretty low. So looking at the top 10, worth noting things like mining and gold mining stocks, home construction in the top 10, and again, most of these fairly negative. If you look at the downside, you'll see automobiles. This is with the big auto companies, also Tesla in that group. Tobacco stocks. Those are all, I guess, reasonable. What concerns me would be something like semiconductors, which tends to be, kind of a leading indicator. When semiconductors are doing well, the market as a whole tends to be doing well. And not to get too deep into the weeds, but to draw some trend lines on here, when I'm seeing this pop up on groups like semiconductors, I don't feel great. That is not a feel good. Now, again, what you have to remember is it's all proper context, right? So an uptrend is a series of higher highs and higher lows. So as long as that trend continues, the short-term uptrend is in place. I think right now we're testing this last swing low, which is just above 3,800 on the semiconductor index we're using here. You could use the SMH or other semiconductors if you like. But looking at that most recent swing low, I think if we get a confirmation, confirming that breakdown tomorrow, that would sort of reverse this and give you sort of a lower low in that tactical time frame, which would be concerning. This breakdown through the trend line support is certainly an area of concern. This index going back below the moving averages, also an area of concern. So, some concerning breakdowns. And again, the broad S&P is where we're seeing that trend line break. We're also seeing it on groups like semiconductors. Software was another one of those groups that was on the bottom 10 list. And again, it's not my favorite that some of those groups are down there. I also just want to finish off our market recap, just looking a little bit at some of the breadth measures. These have been key things we've talked about, and I made the subjective decision of color coding the cumulative advanced decline lines back to green, and I may have probably somewhere in my subconscious thought that's probably when this bear market rally ends, when I finally throw in the towel and color code these. I color code them green, yellow, and red just as a stoplight, just where I see them headed. And I think for me, it's this pattern of higher highs and higher lows, which has emerged with the cumulative advanced decline lines, which is pretty encouraging. If these start to roll over, we change them to the yellow, and then if they break down, new swing lows, we'll switch them back to red. But at this point, that's one of the ways I would validate this potential sell-off that's beginning this week, is to see if we see a rollover in the cumulative advanced decline lines. These haven't updated yet for today's trading, so not quite there. The last thing I wanted to point out was just this one, which is looking at the percent of stocks above the 200-day, percent of stocks above the 50-day. These spiked in a big way, and you had almost a third of the S&P back above their 50-day moving average. Just like we saw with the semiconductors group, if we see this roll over very quickly, I think that would indicate, not that alone is a trading signal, but it sort of illustrates the weakness that is going to be reflected on a lot of individual stock charts. And that's really the benefit of looking at some of these broad breadth indicators. You get a sense of how the individual charts are starting to play out. So that's one of the charts I'll be looking at this week to see if we're getting the breakdowns I think we might be expecting with the short-term pullback. We're going to take a quick commercial break. We'll be back with my guest, JC Parets from All Star Charts. We'll see you in a minute. Hello, everyone. Welcome back to the show. This is Dave Keller here at StockCharts.com. Thanks for joining us every weekday after the close. We're going to have a mailbag segment a little later in this episode. And I'd remind you, you can send questions to us anytime. The final bar at StockCharts.com. They can be questions about particular charts, about the markets in general, about particular tickers, or technical analysis, behavioral finance, whatever it is. We'll do our best to answer your questions, and love answering your questions as part of the final bar. I want to move right on to my guest, JC Parets. JC's from All Star Charts, known JC for a number of years, and I always enjoy talking to him, probably because his comments will probably mirror very closely my own, because I've always found our approaches are similar in many ways, which is one of the reasons why I'm very happy to welcome JC on the show. JC, thanks for coming on today.
Anytime, Dave. What's going on?
Well, we've got a bit of a pullback here. I would love to know, chart number one that you sent us is looking at a sort of an asset allocation decision, looking at a couple different asset classes. What does this sell off today in stocks? How does this fit into what you're seeing across the board?
Listen, when we've done the work and gone back, and when asset classes are in strong uptrends, they don't just do well on an absolute basis. They tend to also outperform their alternatives, right? So what are a couple of pretty good alternatives to stocks? Gold and bonds, right? So when you look at the bond market, you want to see how it's doing compared to stocks and gold. When you look at the stock market, you want to see how it's doing compared to gold and bonds, right? So coming into this weekend, I'm seeing stocks, gold, and bonds all up near 30-day highs, either making new 30-day highs or at them. I'm like, one of these got to give. And our bet has been since last week that it was going to be stocks that roll over and bonds probably, take the lead here and break out to new highs.
It's interesting, and that what you just said reminds me so much of mid-February. You had that similar situation where sort of everything was in rally mode, and you had the sense that something had to give, and that's certainly what happened, soon after that. Now, when you're thinking of stocks, it's obviously not just the S&P. You're looking at small caps as well. What is the relative strength picture telling you here?
It's funny you mentioned February. You're 100% right. We were asking the exact same question then. You're 100% right. And then where did we turn for the answer in February that got us so bearish was small caps, and that we were running into that former resistance from 2018. Well, we were asking the question again now, who are we going to turn to? Let's turn to the leaders. Let's look at small caps, right? They got us out in February. They're getting us out now again. Look at that kickback in the Russell 2000 back towards those 2015 highs, which was also the exact low at the end of 2018. So a lot of market memory here in the mid to high 120s. I think we faded all day. You feed the ducks, and I think we fall back below 100 in the IWM.
So you notice at the bottom of the chart, I love how you point out the momentum. And can you just speak to that? What does that momentum level tell you about the characteristics of small caps here?
Yeah, well, listen, people talk about overbought conditions like it's a bad thing. It's like, oh, JC, I can't buy it because it's overbought. It's like, how can an overwhelming amount of buyers possibly be a bad thing, right? So overbought conditions are a characteristic of an uptrend, right? So I'm marking here that in small caps, we never got overbought, right? So that's characteristic of a downtrend. Sure enough, we rolled over. Now we got oversold now, which is characteristic of a downtrend. You don't see oversold conditions in uptrends. So these are all characteristics of downtrends. We're making new relative lows. So not only do the Russell 2000 stocks, not only are they terrible, but they're even worse than the other kinds of stocks. So like, this is like the great, if you want to be shorting stocks, I don't think we need to be shorting the strongest names. Quite the opposite. Fade the weak names, kick them when they're down, and that's small caps.
So now, again, going back to the asset allocation decision, if we're seeing weakness in stocks, how does that relate to the bond markets, to interest rates?
I ask myself every day, why are bonds going out at all-time highs? Look at TLT. Today is what, Tuesday? TLT went out within a nickel of an all-time high. Why is money flowing into the bond market so aggressively? Is it because we are in the early stages of a sustained uptrend in stocks? Is that why bonds keep going out at new highs? My bet is no. My bet is that the bond market, bond investors, are taking the risk in owning stocks a lot more seriously than the investing public, in my opinion. And the signals the bond market, right? You've been around the street for a long time. Who do you trust? You trust bond traders, or you trust the stock jockeys?
I mean, you always go with the bond guys, and what I've always found, people that I've known that have transitioned from analyzing fixed income markets to analyzing equity markets, and our friend Steve Sutmeyer at B of A comes to mind. He tends to focus much better on risk, because that's how you have to think when you're looking at a company's debt. And so I think you're absolutely right, leaning toward the bond guys.
So what's it going to take to get bullish equities, right? What's it going to take? Well, bonds got to stop making new highs, right? The 5-year yield to me is the chart. It's been such an anybody who's interested in the interest rates in the bond market, the 5-year yield, you guys who have been following me for a long time know how often I bring this up. This is like, Dave, this is like the cheat code for trading bonds. I mean, this is what a great indicator it's been. And if we're below 60 bips, which are the 2012 lows, I think you got to be long bonds. So where are we wrong? 5-year yield gets back above 60 bips. Russell 2000 small caps IWM gets above 127. I think that those things happen. JC's wrong. We got to buy stocks, but I think that is the much lower probability outcome.
Those are 3 fantastic charts, JC, and such a great take on how to approach and how to get your mind around this market here. I know the viewers can't see what you're wearing, but I did want to point out that JC did not disappoint. You have a Fibonacci t-shirt on, so let's not let you go without mentioning and crediting you for that decision. All right.
I figured if we're going to do a nerd video, I might as well dress the part, right?
Well done. Cheers, JC. Thanks again for coming on your show. Look forward to having you on again soon. All right.
All right. Thanks, Dave.
All right. Take care. That was JC Parets from Charts. And again, what I love about JC's approach, it is so simplistic in such a good way. And I find so many people love to complicate things. When I talk to JC, you get very specific, very clear answers about what to look for. And I'm going to be paying a little more attention to the 5-year yields after talking to him. Our next segment, folks, is opening the final bar mailbag. As you probably know, one of our favorite things to do is answer your questions on what you're dealing with, what you're experiencing. Again, I think the goal of the final bar is to help us all navigate this environment together. So I did want to start out with a poll that we did actually not too long ago. We asked on the StockCharts TV page. We always have a poll going on the right side. I encourage you to answer that anytime you can, because it helps us have a good dialogue back and forth. We asked you, how confident do you feel about your understanding of the market's current movements? And I would say the by far the strongest answer with 39% was, in general, I understand why the market has moved the way it has recently. Only 8% said everything sort of makes sense, sort of the all-in answer. Below that, we had about half the time, I get it, other half not so much. We had them often confused by the market's movements, and the market is just plain insane right now. We had about an even response to each of those. So, you know, over a third of you said you have a good sense of what's happening. And, you know, arguably, I think that's true. I think there's a different, and again, we could ask the question so many different ways. So a couple quick observations. Number one, we asked how would you understand the current movements? And I think it's relatively easy. It's much easier to look back and understand why things may have happened a certain way versus do you have an understanding about where things are headed next? And I would bet if we asked the question in that way, the number 5 answer, the market is just plain insane right now. I don't know how you couldn't at least give that as one of your options if you're given a couple different choices. But that's great, and hopefully watching what we're doing on the show here and on StockCharts TV with so many great experts giving you some insights and their experiences. I hope that's helping you answer that question a little bit further up the ladder in terms of having more and more understanding. Question number 2, and this came to us via Twitter, by the way, what is the massive spike in volume in the last half hour? Is that an unusual or an abnormal occurrence, or does this usually happen? That's a really good question. I'm going to bring up a chart of the spiders, the SPY. I'm going to look at the last 5 days, and I have the volume here. It's the green bars that you see below here, and I have some other things. Just don't worry about that. So this is the last 5 days of trading. And then I have the 5-minute segments of volume. So if you can see in each one of these trading days, you have a good amount of volume in the first 15, 20 minutes, then it sort of tapers off, bottoms out, usually around lunchtime, relatively quiet, and then you see the big spike going into the close. Some days it's a little more muted. So yesterday's volume was not extreme going into the close. The day before, on Friday, you had a huge influx of volume going into the close. It dwarfed the rest of the day's volume. So what's going on here? So the short answer is no, that is not abnormal at all. That's actually relatively normal. If you look back for years and years and years, ever since I've been following the markets in around 2000, that's pretty much the standard move for equities. Now, what it means, the longer answer is that there's a lot of things that can mean. So in general, 2 things that are coming in at the end of the trading day in that last 30 to 60 minutes, right? Number 1 are big institutions. So if you're at a Wellington or a State Street or a big, some large investment firm and you need to be accumulating shares or distributing shares, usually wait to the end of the day to dump a big order into the markets. Or even if you're peppering orders around, that's usually where the big influx of activity is going to come. So you usually can attribute that last 30 minutes to a lot of institutions making their changes for the day. They don't want to do them earlier in the day and sort of shock the market, sort of get them in right at the end. It minimizes the potential impact, gives the market a day to digest what's happened there. So that's part of it. The second thing, though, is where ETFs come in. So ETFs will have to change supply and demand based on what they're seeing with the structure of the ETF. So you'll have a lot of ETF rebalancing, things that have to come in at the end of the day to accumulate shares or spit shares back out, distribute shares based on the demand for the ETF, actually for the underlying stock. So that's going to be part of the impact as well. So, I often talk about that last 30 minutes as being a good indication overall. The direction of that last 30 minutes can be one indication about sort of where the sentiment is going into the close, what the big institutions and the ETFs that have to be that are forced into accumulating shares or distributing shares, what that means. It is not 100%. It doesn't mean if you sell off going into the close that tomorrow is going to be lower. And you saw that on the 15th, which was last Wednesday, you saw some distribution going into the close, and we distributed going into the next day, but overall finished more toward the highs of the day. Same thing on Friday, at a big rally into the close, but then obviously a lot of news, a lot of things happening between there and there. So you have to remember it's that might indicate the sentiment going into the close, but also you have a lot of overnight news, earnings, and everything that are going to impact things as well. So that is the spike in volume. It is totally normal, and that's what it represents. Next question, is this some sort of global economic restructuring where technology has a V-shaped recovery while fossil fuels suffer the seventh extinction? That is the most beautifully worded question I may have ever read. So thank you so much for taking your time with that. So, what does that mean? I think, yes, I think in some ways that does represent sort of this change in dynamic where you have things like technology leading the way higher. I don't know if that necessarily means what you're suggesting, though. I would say that the spike in technology, the leadership over the last year has certainly indicated the importance of tech, not just in bull cycles, but in bear cycles. So when the market rolled over, you also had technology outperforming. If and when that starts to change, I think that will be a huge implication for a changing environment where we're not just flying to the defensive big cap tech names like Microsoft, and we're trying to go other places, maybe healthcare and elsewhere, because certainly technology has been the leadership up until now. In terms of energy, obviously there's a lot of disruption with oil prices. I think it more speaks to the short-term direction of things and not necessarily a huge sea change. The last question was in crude oil, but we just don't have a ton of time to talk about it. But I do want to try to address it. I'm actually putting out a video on my YouTube channel to try to get into this a little further. Maybe I'll write an article on it as well. But I would point out with the USO, I think a lot of people incorrectly assume that the USO or an ETF like that is giving you direct exposure to crude oil prices. And it's not necessarily the case. And the reason is this: commodities and futures basically roll over once a month or once a quarter. And at the end of that, you basically have a rollover and you have an expiration of one contract and it goes to the next. So the May contract for crude oil is what actually dipped way below zero. The June contract was actually the current contract. That's where most of the players are actually trading. It's still up in the $20 range or whatever, since it's yesterday before things continued to go lower. The USO actually has to roll over those contracts every month. So there's actually a decay automatically built into the USO, assuming that crude oil futures trade as they normally do. So you automatically are losing money by owning the USO every month because it has to roll to the next contract. It usually has to pay a premium to get to the next contract. And so you're deteriorating the value, which is why as a long-term bet, it's usually not a great opportunity. But there are other ways to bet on oil prices in terms of equities and others. So I'd encourage you to experiment with that. But basically, my reminder to all of you is don't think of zero as an absolute bottom. While theoretically for something like a stock, it really can't trade below zero. A lot of things can, and in ways that will probably surprise you. In particular, interest rates going below zero, commodities trading below zero. It can happen, and that's what we found again this week. That's our mailbag for today. And again, those are all questions from you guys in the last day or two. Thanks so much for sending them to us. We need to wrap up the show and go right to the 3 and 3 charts in 3 minutes. And here we go. And I'm told we need to go even quicker, so I'm going to do my best. Chart number 1 is looking at Dow theory. And again, what concerns me with Dow theory is this illustrates the strength of the bear market rally with the Dow Industrials and the Dow Transports, both of them now breaking down through trendline support. This is what we talked about earlier with the S&P, with semiconductors, with a lot of groups and a lot of stocks. I think a follow through for the remainder of this week is going to illustrate some real inherent weakness in stocks, and that's going to be concerning, I think, for sure, especially if you're on the long side, if you're bullish. Chart number 2, JC Parets earlier, my guest was talking about small caps as a great indicator of what's happening. Looking at the leadership coming from the market bottom, you can see that the S&P and mid caps both up about 23% from the market low on March 22nd, 23rd. Small and mid caps have actually been lagging, and small caps have been the worst of those 4, actually underperforming micro caps. So it's underperformed stocks by about 5 or 6% for the last since that market bottom in March. Finally, the breakdown in commodities. We didn't get a ton into that today, but oil certainly has come down significantly with tons of supply and oversupply, nowhere to store the oil, and weakening demand. It's sort of this perfect storm of oil price weakness. So most commodity indexes are tied very heavily. They're overweighted with energy. So if oil's weakened, things like the CRB, the GSCI, all of those are going to be very, very low. This is actually an equal weighted commodity ETF, GCC, also showing weakness, not as much as the other commodity ETFs and indexes, but also showing some weakness. So the weakness in commodities certainly seems like it has further to go. And ladies and gentlemen, that's our show for today. Thanks for joining us on a Tuesday afternoon for the final bar. I want to thank my guest, JC Parets from All-Star Charts. Look him up on Twitter at All-Star Charts. Also, check out our YouTube channel for all of our previous episodes. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.